Rising Treasury yields. Everyone's watching them. The 10-year just hit 4.2%. The 30-year pushed past 4.8%. And according to every mainstream analyst and every talking head on financial television, this is all perfectly normal. The Federal Reserve cut rates 3 times this year, so yields should be falling, right? Yet here we are in December 2025, and long-term borrowing costs keep climbing higher despite the Fed easing short-term rates. But what nobody's telling you is what's really happening beneath the surface. What nobody wants to talk about is the hidden stress that rising yields create throughout the entire financial system. Stress that doesn't show up in the headlines, stress that mainstream theories completely ignore, and stress that, if you know where to look, it is screaming warnings about what's coming next. The mainstream narrative goes something like this. Yields are rising because the economy is strong. Stronger than expected labour market data provided additional upward pressure on Treasury yields, suggesting a more robust economy. Initial jobless claims dropped to their lowest level since 2022. The Fed can slow its rate cuts because everything's fine. Nothing to see here. Except that's not the whole story. Not even close. While the Federal Reserve is easing short-term rates, the market is bracing for persistent inflation and increased bond supply. What we're witnessing is a complete divergence between what central bankers think should happen and what markets are actually doing. The yield curve is steepening. Long-term rates are climbing while short-term rates fall. And if you believe interest rate theory, the way it's taught in every economics textbook, this steepening should signal confidence in future growth and expansion. But that's where the mainstream story falls apart, because buried in the mechanics of how these markets actually function, there's a different story emerging. A story about funding stress, about leverage unwinding, about the plumbing of the financial system starting to crack under pressure that most people don't even know exists. Let's start with the repo market. Most people have never heard of it. It's the overnight lending market where banks and dealers exchange high-quality securities like Treasury bonds for cash. Around $900 billion in transactions per day, with high-volume days in recent years, around $1.5 trillion. This is the circulatory system of modern finance. When it functions smoothly, nobody notices. When it doesn't, everything breaks. And right now, it's showing stress. The Secured Overnight Financing Rate, SOFR, tracks a $3 trillion per day segment of this market. SOFR has been volatile recently, hitting 3.9% before dropping to 3.66% just yesterday. That might not sound dramatic, a few basis points here and there, but here's what matters. SOFR is trading above the Federal Reserve's policy rate. Above the level where it should be trading if everything was functioning normally. In other words, a sudden cash drain caused the usual lenders in overnight markets to step back all at once, leaving borrowers scrambling for funds and driving rates sharply higher. This is a liquidity squeeze, not a credit panic, not yet. But it's the kind of thing that happens when bank reserves are thinner than they appear. When the buffer that everyone assumes is there starts to disappear. Bank reserve levels have declined from peak levels of approximately $4.2 trillion in 2021 to current levels near $3.1 trillion, approaching what many analysts consider the minimum comfortable operating level. The Federal Reserve ended its balance sheet runoff program in December, earlier than expected. The Fed announced it will halt Treasury balance sheet runoff effective the 1st of December 2025, ending the quantitative tightening program 3 years after it began. Why? Because the stress in funding markets was becoming too pronounced to ignore. The standing repo facility, the Fed's emergency backstop for funding stress, has been used intermittently. Emergency injections totaling $125 billion in recent months, with increasing frequency of facility utilization. When banks start accessing emergency facilities despite penalty pricing, that tells you something's broken in private markets. It tells you the system is operating closer to its limits than anyone wants to admit. Now here's where this connects to rising Treasury yields. And this is the part that mainstream economics gets completely backwards. According to textbook theory, when yields rise, that should attract capital. Higher yields mean better returns. Money should flow into Treasuries, supporting their prices and limiting how high yields can go. It's basic supply and demand. Except that's not what's happening. Instead, we're seeing evidence that rising yields themselves are creating stress that forces more selling. Market illiquidity, because of deleveraging pressures that may have forced sales of Treasuries to raise cash. This is the opposite of how it's supposed to work. Here's the mechanism. Many market participants, particularly hedge funds and leveraged investors, use Treasuries as collateral for other trades. They borrow against these supposedly safe assets to make bets elsewhere. When Treasury prices fall and yields rise, the value of that collateral decreases. Suddenly, they're getting margin calls. They need to post more collateral or reduce their positions. And what do? They sell Treasuries, which pushes yields higher, which triggers more margin calls, which forces more sales. It's a feedback loop, a self-reinforcing spiral that has nothing to do with economic fundamentals and everything to do with the mechanics of a leveraged financial system. As of October 2025, outstanding margin debt reached approximately $1.18 trillion, a record high representing a roughly 45% year-over-year increase. Think about that. Investors are borrowing more money than ever to buy stocks, not because they have a strong conviction in the economy, but because leverage has become the oxygen of this market. Because everyone's chasing returns in an environment where traditional safe assets barely keep pace with inflation. And this isn't just retail investors playing with margin accounts. Central bankers are starting to appreciate how much major government debt markets are being dominated by a handful of hedge funds. These are massive leveraged positions in the Treasury market itself, the very market that's supposed to be the bedrock of global finance. The problem is that leverage works both ways. It amplifies gains on the way up, but it also amplifies losses and forced liquidations on the way down. The recursive property of leverage, whereby higher leverage by one player begets higher leverage overall, reflecting the nature of debt as collateral for others. This is systemic risk hiding in plain sight. Risk that regulators see but don't know how to address without triggering the very crisis they're trying to prevent. The dilemma is how to get hedge funds to suddenly reduce their market share without triggering a market meltdown. Now let's talk about what rising yields mean for credit markets, because this is where the stress really starts to cascade through the system. Credit spreads, the difference between what corporations pay to borrow and what the government pays, have been extraordinarily tight. The yield premium on high-yield bonds versus US Treasuries is just about as narrow as it has ever been in history, at only 2.8%. Investment-grade corporate spreads around 100 basis points. High-yield spreads that were below 260 basis points earlier this year. These tight spreads meant corporations could borrow cheaply. It meant investors searching for yield were willing to take on more risk for very little additional compensation. It created an environment where even the shakiest companies could access capital markets. But here's the thing about credit spreads. They're remarkably stable until they're not. And when they start to widen, they widen fast. Given that both high yield and investment grade spreads have increased recently, a possible increase in financial stress and potential losses for bondholders are possible. Why do spreads widen? Because investors suddenly realize they're not being compensated for the risks they're taking. And what makes them realize that? Often, it's rising base rates. When Treasury yields climb, the math changes. If you can get 4.2% on a risk-free 10-year Treasury, why would you lend to a corporation with questionable credit for only 3% more? You wouldn't. So spreads have to widen to attract buyers, which means borrowing costs for corporations jump, not because the Fed raised rates, but because the market is repricing risk. Widening spreads illustrate a larger difference between corporate and government bonds, which implies greater credit risk and rising economic uncertainty. And we're starting to see this happen. Credit spreads have moved off their lows. Not dramatically, not yet, but enough to raise questions. Enough that credit market participants who know what they're looking at are getting nervous. Because here's what credit market stress means in practice. It means companies that need to refinance debt face higher costs. It means investment plans get postponed. Capital expenditures get cut. Hiring slows. And if spreads widen enough, it means the weakest companies get shut out of credit markets entirely. Widening credit spreads may, in fact, cause economic downturns by cutting off the supply of capital to companies, which in turn respond to deteriorating financial conditions by postponing investments, cutting back on spending, and laying off staff. This is how financial stress transmits to the real economy. Not through the mechanics that central bankers describe, not through the interest rate channel, which they try to control, but through the functioning of credit markets that respond to forces central bankers barely understand and certainly can't control. And there are early warning signs that stress is building. Delinquency rates on credit card loans have soared to their highest levels since 2011. Auto loan delinquencies are at levels not seen since 2010. These are leading indicators. They show up before credit spreads blow out, before the economy officially tips into recession. Now, some will argue that credit fundamentals remain solid, that corporate balance sheets are strong, that default rates remain low. And technically, they're right, for now. But that's exactly the point. Stress doesn't announce itself with flashing red lights. It builds gradually in the background, in funding markets, in leverage ratios, in the compression of risk premia to levels that make no sense given the actual risks, and then something breaks. It might be a spike in repo rates that forces deleveraging. It might be a sovereign debt crisis in a country nobody was paying attention to. It might be a major hedge fund that miscalculated its basis trades and faces catastrophic losses when Treasury volatility spikes. Nobody knows what the trigger will be, but the vulnerabilities are there, growing, hidden beneath the surface calm. Here's what makes this particularly dangerous in December 2025. We're operating in an environment where traditional correlations have broken down. For decades, when growth slowed and stocks fell, bonds rallied. The flight to safety was automatic. Treasury prices rose, yields fell, and bond investors were protected. However, since 2022, this correlation has broken and remains broken through early 2025. For the first time in over 30 years, stocks and bonds fell together. Why? Because inflation changed the calculus. Because a fixed yield loses value in an inflationary environment. And now, even as inflation has moderated, even as recession risks have risen, bonds still aren't finding buyers at these yield levels. With inflation coming down, a struggling consumer, and increased expectations of a global recession, US government bonds, the tried and true haven for this type of environment, are still not finding buyers. This is not normal market behaviour. This suggests something fundamental has shifted in how investors view sovereign debt. Maybe it's concerns about massive government deficits. Maybe it's fears about inflation returning. Maybe it's a reassessment of whether US Treasuries deserve their status as the ultimate safe asset. Whatever the reason, it means the playbook that worked for 40 years no longer works. It means portfolio managers who built their risk models on stocks and bonds moving in opposite directions need to completely rethink their approach. If we truly are seeing the correlation between bonds and stocks breaking, it will be a major inflection point in market dynamics. And it means there's no obvious haven when stress hits. When everything falls together, where do you hide? The answer, increasingly, appears to be cash or gold. Spot gold has traded above $4,271 per ounce after reaching a record $4,398 in mid-October. Gold returned over 60% in 2025. That's not the behaviour of a market that's confident in central banks and government bonds. That's the behaviour of a market that's searching for alternatives to a system it no longer fully trusts. Now, let's connect this back to where we started. Rising Treasury yields in an environment where the Fed is cutting rates. Why does this matter? Why should anyone care about technical indicators in funding markets and obscure measures of leverage? Because it all fits together. It's all part of the same system, and that system is showing stress in ways that most people aren't equipped to recognise. The repo market stress tells you bank reserves are tighter than comfortable. The rising margin debt tells you speculation is at extremes. The breakdown in stock-bond correlations tells you traditional hedges aren't working. The tight credit spreads tell you investors aren't being compensated for risk. And the rising long-term yields, despite Fed cuts, tell you markets don't believe in the central bank narrative anymore. Each of these individually might not mean much, but together they paint a picture of a financial system operating at its limits. A system where leverage has been piled on top of leverage, where the mechanisms designed to provide stability in times of stress are themselves becoming sources of instability. And the scariest part? Most of this stress is invisible to the average investor. To someone watching stock market indices hit new highs, everything looks fine. The S&P 500 is near records. Corporate earnings are solid. Unemployment is low. Why worry? But that's always how it works. Stress builds in the plumbing, in the parts of the market that function smoothly until they don't. In March 2020, nobody saw the Treasury market chaos coming until it arrived. The problem wasn't a lack of liquidity. It was that primary dealers couldn't absorb the volume of bonds in stressed conditions. In September 2019, the repo market seized up overnight. Rates spiked to 10% when they should have been around 2%. Why? Because bank reserves had been drawn down just enough that when quarterly tax payments pulled more liquidity out of the system, there wasn't enough buffer left. The same dynamics are in play now. Different specifics, same underlying vulnerabilities. Reserves would need to fall below $2.7 to $2.5 trillion before significant stress emerges. We're not there yet, but we're close enough that the Fed halted its balance sheet reduction 3 years early. That should tell you something. It should tell you that behind the scenes, central bankers are more worried than they're letting on. That the resilience everyone assumes exists is more fragile than advertised. So what does this mean for what comes next? What happens when rising yields finally trigger the stress that's building? The honest answer is nobody knows exactly. These are complex, non-linear systems. Small changes can trigger disproportionate responses. A funding squeeze that seems manageable one day can spiral into a full crisis the next. But we can outline the mechanics. If repo rates continue rising, leveraged investors face increasing costs to maintain their positions. Eventually, some will be forced to deleverage. That means selling Treasuries, which pushes yields higher, which creates more pressure on other leveraged investors. If credit spreads widen meaningfully, companies with refinancing needs will face higher costs. Some won't be able to refinance at all. Defaults will rise. Credit funds that loaded up on risk when spreads were tight will face losses. Redemptions will force more selling. If margin calls accelerate, investors will sell whatever they can to meet them. Starting with the most liquid assets, Treasuries, investment-grade bonds, blue-chip stocks, creating selling pressure across markets simultaneously. And if all this happens at once, you get a liquidity crisis. Not because there's no money in the system, but because everyone wants cash at the same time and nobody wants to provide it at anywhere near normal prices. This is what 2008 looked like. This is what March 2020 looked like. Different triggers, same underlying dynamic. A scramble for liquidity in a system that suddenly doesn't have enough to go around. Now, maybe none of this happens. Maybe the Fed's early end to balance sheet runoff stabilizes funding markets. Maybe credit spreads stay tight because corporate fundamentals really are solid. Maybe margin debt can stay elevated indefinitely without triggering problems. Maybe, but probably not. Because the lesson of financial history is clear. When leverage builds to extremes, when risk premia compress to levels that don't make sense, when hidden stress accumulates in the plumbing of the system, something eventually gives. The timing is always uncertain. The catalyst is always a surprise. But the outcome is inevitable. What's different this time is the scale, the amount of leverage, the size of the markets involved. The interconnections mean stress in one area immediately transmits everywhere else. And the fact that central banks have far less ammunition than they did in previous crises. The Fed can't cut rates much more. They're already at 3.5 to 3.75%. They ended the balance sheet reduction, but actually expanding the balance sheet again would require acknowledging that something's seriously wrong. That's politically difficult in an environment where they're still claiming the economy is strong. So the tools available to address a crisis are limited, which means if stress does trigger a broader breakdown, it could be more difficult to contain than previous episodes. All of which brings us back to rising Treasury yields. To most observers, this is a story about economic growth and inflation expectations. About the Fed's policy path and whether they'll cut rates more or less than expected. But if you understand how the system actually works, rising yields in this environment are a warning sign. They're telling you that funding conditions are tightening, that leverage is starting to bite, that the plumbing is under more pressure than it can comfortably handle. They're telling you that hidden stress is building, stress that will stay hidden until it isn't, until something breaks and everyone suddenly realizes the system was far more fragile than anyone wanted to admit. And the worst part is that mainstream economics has no framework for understanding this. Central bankers look at interest rate differentials, inflation expectations, and output gaps. They build models that assume markets function smoothly, that leverage is always manageable, and that liquidity is always available when needed. They're operating with the wrong map, using theories that were never designed to capture the reality of how modern financial markets actually work, missing the signals that matter because those signals don't fit their models. Which means when stress finally manifests, they'll be caught off guard. Again, just like they were in 2008, just like they were in 2020, just like they were in 2019 when the repo market seized up. The signals are there. The vulnerabilities are visible to anyone who knows where to look. Rising yields in an environment of Fed cuts, stress in overnight funding markets, record margin debt, breakdown of traditional market correlations, credit spreads that make no sense given actual risks, each one a data point, each one a warning, each one telling the same story if you're willing to listen. The story is that the financial system in December 2025 is operating at its limits. That hidden stress is building in ways most people don't see. That rising Treasury yields aren't just about growth and inflation. They're about the mechanics of a leveraged system starting to show cracks. And that is when those cracks widen into breaks, the consequences will be far more severe than anyone watching stock market indices expects, because this time there's nowhere to hide. No traditional safe haven that's working the way it should. No central bank cavalry that can ride to the rescue without acknowledging failures they're not prepared to admit. We're in uncharted territory, operating with more leverage, more complexity, and more interconnection than ever before, and the warning signs are flashing for anyone willing to see them. Rising yields aren't just rising yields. They're a window into the hidden stress building throughout the system, stress that mainstream theories ignore. Stress that will only become obvious when it's too late to do anything about it. That's the reality. That's what the data is telling us. And that's why, in December 2025, those of us paying attention to what's actually happening rather than what we're told should be happening are more concerned than we've been in years. The question isn't whether stress exists. The question is how much more the system can take before something gives.